what you have left to invest or spend on for other things. So that's working capital. Now, always your capital deals with current assets and current liabilities, and current means it's liquidated accounts receivable, marketable securities, inventory. The current liability would be amounts that are owed stakeholders like your vendors, your employees, and any loans that are payable within a year. And working capital is used to determine the company's ability to finance immediate operations. In other words, buy inventory, write new policies, obtain credit, things like that. And then we have working capital, but one of the things that the finance department does is manage that capital. And how they allows receipt and disbursement of cash. And here are some examples of working capital decisions the finance department goes through. How do I invest my cash? Do I borrow or do I pay for something? Do I borrow money or do I pay cash? Do I extend customer credit? What levels of inventory should I carry? Those are the kinds of questions or capital decisions that are made by the finance department. This slide is extremely important. You absolutely have to understand each one of these accounting principles and concepts. Remember the going concern concept. All annual statements on non-insurance corporations, or rather should I say GAAP corporations, is the going concern concept. That means that you assume the company is going to continue indefinitely and all held stocks, bonds, loans are going to come to their fulfillment or maturity. The cost principle requires a company's assets to be recorded at their acquisition or production price. May not be at their market value, okay? It's a cost principle. Revenue recognition principle requires revenues to be recognized and recorded when the services are rendered or the goods are sold. So you want to match your revenue with the item that you're receiving the revenue from. The matching principle, that requires expenses used to generate revenues match with those revenues. So that's where I want to take my costs, my expenses, and match it with my income. If I sold a widget for $5,000 and it cost me $4,000 to make it, then I match them at the same time to give me a net of $1,000. Your actual versus cash basis accounting, very important. I'm sorry, accrual versus cash basis. Very important to understand these. Accrual basis accounting is where revenues and expenses are recorded as they are incurred rather than when received or paid. And that's important, for example, in insurance, because even though you may receive the payments, they're not earned, okay? They're not GAAP when recording items that are not material if it's less expensive or more convenient to do so. The consistently principle is very important. It says that an organization has to use the same accounting principles and reporting practices every accounting period unless they're allowed to otherwise. And there are a couple of key examples are when value